Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hi, everyone. Thanks for joining the GAAP conversions between US and Europe for CFO and Controllers. My name is Katrina Nacci. I'm a US CPA, and thanks for being here with me. So before we get into the details, I just want to introduce myself a little bit and explain why I am qualified to speak about this topic. I'm a cross-border accounting advisor based in Europe, having spent the past 11 years as an expat between Frankfurt and Dubai. So I'm originally from Rhode Island. For those of you in Europe who maybe don't know where Rhode Island is, it's the smallest state, very close to Boston. I started my career with PwC in Boston, working in the audit practice, focused on tech companies, doing a lot of public company audits there. But I moved over to Frankfurt in 2013 to work for a joint German and US listed company to do their SEC reporting. Thought I would try it out for a year, and 11 years later, I'm still here. So I've spent most of my career actually with PwC. I was also a local hire in the Frankfurt team in the capital markets and accounting advisory group, where we were specialized in taking European companies public in the US or working on accounting conversions when there were acquisitions between the US and Europe. I was also on secondment with them for a couple of years in Dubai, working on capital markets locally there around the region, also into the UK and the US. And then I spent 3 years in private equity for a North American real estate asset management firm. They brought me in as their first European finance hire to build up all the processes, procedures, put a team underneath me in Luxembourg, and then we were quite acquisitive all around Europe. So between the big four plus the industry experience, I have experience now with probably 10 different European statutory and regulatory environments as well. And I've been working now independently for the past 2.5 years in the cross-border accounting advisory space, specifically helping European companies bring more sophistication to their accounting and reporting when they're dealing with bringing in US stakeholders for the first time. So we'll talk a little bit about what those types of triggers might be and the types of companies that I'm working with and how it might apply to you. But I'm working both with US counterparties and European counterparties. There's very different nuances for kind of helping them to bridge the gap in their knowledge when you're working in the cross-border space. And I'm specifically talking about US and Europe transactions here. That's what I specialize in. But of course, the general process to follow for a GAAP conversion is likely the same regardless of whether you're going into Asia, South America, etc. A little bit of housekeeping. I know there was already an intro to this video, but in case you joined a little bit late, just if you need continuing education credits, CPEs of any sort, just make sure you're on the Earmark app so you can get the recording and get the quiz that you need to be able to get your certificates from that. So there's 5 main learning objectives today that I'll go through in a bit more detail, but I would like to better understand for who's on the call live right now, who's already planning towards a GAAP conversion for 2025 or has done one in 2024. Happy for you to leave some comments in the chat, either in StreamYard or LinkedIn or wherever you're tuned into. But I'll otherwise just run through these learning objectives. And then, of course, I'll pause a couple of times in the presentation to see if there are any questions on what I've covered so far. So the first objective is to identify key triggers and requirements for when you might need to go through a GAAP conversion when you're working through a transaction between the US and Europe. The second is to put together a plan to be able to manage that GAAP conversion process. And this is something that I really advocate, especially when I'm working with smaller companies in the scale-up space who normally can't afford to work with a big four firm. And if they can, they want to do it in the most effective and cost-effective way possible. And that really makes sure that you're in the driver's seat for the entire strategy so that, it's not the firm that's coming in and telling you need to do A to Z and they're leading the entire process kind of in a black box and you don't know what's going on. I really am looking towards empowering your teams to make sure that they're the ones that are driving the strategy for when and how and what parts of the process you're including advisors. The third objective is to assess the timing considerations, especially when you're dealing with transaction like a fundraise or M&A, for what parts of the GAAP conversion do you need to do kind of during the close and then post transaction in order to kind of balance out the work when and where you can and be as proactive as possible. The fourth objective is to incorporate kind of some related aspects. There's a lot of nuances that go into cross-border accounting and transactions, and I'm only normally coming in to pinch hit and cover a very specific piece of that related to the GAAP conversion itself. But CFOs are dealing with a lot of other topics at the same time. You might be dealing with systems and how to do multi-GAAP in your ERP for the first time, looking at the multi-FX in your ERP as well. How do you consolidate multiple international subsidiaries and the like? So it's also kind of tangential to what we're talking about. And then lastly, just to formulate a strategy for how you would collaborate with advisors and auditors when you're going through this type of process. I also just want to point out what this training is not. And it's not meant to provide a comprehensive list of differences between, say, IFRS and US GAAP. And there's three main reasons why I don't like to get into these types of details in a more general training setting. And that's because, firstly, those differences aren't going to be specific to your company. So it's really more beneficial to kind of look under the hood of what you're actually doing versus what the standards might say in practice. And of course, there's probably different policy choices as well that you may or may not have made. So looking at some generic kind of differences guide maybe gives you a false sense of security that you understand all of the differences when in fact you actually need to dig into what you're actually doing. It also depends on which way you're going through the conversion. So whether you're going from IFRS to US GAAP or from US GAAP to IFRS may also result in different differences because there's different, again, allowances that you're able to make between those two standards. And so I'm also very careful when I work with companies to make sure where there are those choices, that we're keeping them as possible to the current GAAP so that there's less work they have to do, unless we see that their peers are doing something different and maybe they would like to change to a different policy, even if they have the choice to remain consistent. And the third thing I want to point out, which especially trips up a lot of US CFOs that I talk to, is I get the question a lot around IFRS versus US GAAP differences. And I understand the underlying question there is that a lot of US CFOs maybe think that all European companies are automatically reporting under IFRS, and that's actually not the case. Most European companies that I'm working with, like I said, especially in the scale-up space, unless they're already sophisticated enough that they've done some large fundraising or they're public in Europe, they're probably not even under IFRS. They're probably under their local statutory GAAP. So you may even be kind of assessing the wrong conversion exercise if you don't really understand and take note of all the different jurisdictions you're in or you're looking to go into and which GAPs those companies are operating under. So the first section is going through what are the different conversion triggers, why GAAP conversion matters, and looking more specifically at the requirements that you need to go through with a GAAP conversion. So of course, GAAP conversions matter. Firstly, because you want to make sure you're keeping the integrity of your local GAAP across Europe, for example, to make sure that you're staying compliant across all of the different jurisdictions. Every country in Europe basically has their own local GAAP, and there's specific timelines associated with putting your tax returns together and potentially also uploading it to public domains, depending on the company and country and company size, etc. So you want to make sure that you're staying compliant. But at the same time, when you are bringing in stakeholders that are looking at your consolidated group, you need one set, obviously, of accounting policies that you're applying to those consolidated statements in order to give transparency to your stakeholders. And all of that helps you basically to minimize your operational risk, to make sure that you're able to produce those consolidated financials to your stakeholders, whatever timelines are required per your investor or public listing agreements. And then, of course, to allow you to get through M&A, fundraise, et cetera, to the standard that your stakeholders would require. In terms of triggers for GAAP conversions, these are the most common ones that I normally see. So I'm normally helping European companies that either have just done a big fundraise round or are looking to do fundraising with a large US private equity or venture capital firm. I typically see the pattern kind of start to emerge around Series B, is where those investors start to ask for either IFRS or US GAAP reports. Kind of before that, at the venture capital level, for example, they're typically a little more lenient to allow you to keep using local GAAP, but it again depends just on the investor requirements themselves. It could be even earlier that you're required to put that together. The second reason I help companies through a GAAP conversion is when there's an acquisition happening between the US and Europe. And again, it's a matter of then bringing that European local GAAP, for example, into the US GAAP consolidated accounts and having a conversion adjustment that shows you how to bring it up to your US policies. The third reason for a GAAP conversion would be European companies that are going through a US IPO and either need to convert to IFRS or US GAAP. There is the choice, not necessarily the choice, but there's the ability to use either IFRS or US GAAP if you're doing a US IPO, depending on whether you're meeting certain requirements to be listed as a foreign private issuer. So that's something to consider as well. You don't necessarily need to convert to US GAAP just because you're doing a US IPO, but you may want to if your peer companies are on that standard as well. And the fourth trigger is really interesting because a lot of times when companies hear that I do cross-border accounting advisory, they come to me almost too early in the process. A lot of times it's a European company that's just setting up a US subsidiary or a branch, and they ask if I can help. But in that case, they normally just need US tax support and a bookkeeper in the US to keep up with all the IRS filings, but they don't necessarily need a full-blown GAAP conversion on that US subsidiary, especially if they're a smaller company and they don't have consolidation requirements to consolidate into Europe and have to deal with kind of the conversion going the other way. However, the exception here is for companies that are in regulated industries. So I've worked with a couple of different fintech companies this year in the UK who are setting up US subsidiaries. And because they're regulated either locally by the states they're going into and or by the SEC, they have requirements basically day one on the ground in the US to have full US GAAP financial statements that are getting audited every year. So it's something important to consider. In terms of identifying the actual requirements around going through a GAAP conversion, we'll of course get into the process in a little bit more detail, but there's a couple of different things to consider. First of all, what's the actual scope of your conversion? Do you just need to convert this current year? Or if you're going through an audit, again, this is important to involve your auditors early, do they also need to audit a comparative period or maybe an opening balance sheet where you're dealing with actually converting multiple trial balances at that point? It's also just taking general stock of the inventory of where you have different legal entities in Europe and the US, and what are the GAAP standards required across all of those entities, and included in that inventory, not just the GAAP standards, but also the timing for getting through an audit locally if and when you need to go through statutory audits to make sure that you're kind of lining up those audit timelines as best as you can to alleviate the burden on the internal team as well. Of course, a key part of identifying the conversion requirements is understanding the differences in the policies. So we'll get through that a little bit later. That's a lot more of the detail that I've included in the GAAP conversion process itself. As I mentioned before, another key component is really planning your tech stack and whether or not it can accommodate you maybe having to deal with multi-GAAP for the first time. So working with smaller systems like a QuickBooks, for example, could make it a little bit more difficult to be able to consolidate multi-GAAP ledgers, have a separate conversion ledger, intercompany, et cetera. And you also want to make sure you have robust enough rules when you need them in terms of the FX calculations that you're dealing with. So a lot of times when I'm working with companies on GAAP conversions, they're also going through system implementations around the same time. I've actually had a talk with a couple of them just this week where I've recommended, okay, if you want to do a system implementation early next year, you actually want to identify your accounting differences before that, so that you already understand kind of the framework that you would need to book up to US GAAP, for example, so that when you're working with your system implementation experts, you're building that framework into how the system is structured kind of from the get-go, so you don't have to go back and redo some of that. And then, of course, it's important just to make sure that this entire process around the conversion exercise is documented for your auditors. And I'll say it several times, just make sure you're having these conversations early and often so that there's agreement on exactly what you're producing for documentation. I put a couple of different case studies here that I thought were interesting to talk to, kind of split them into two segments. The first way that I typically see companies going through GAAP conversions is starting up their US operations. So I've worked with a UK tech company that made a US acquisition, and I've never had to have consolidated accounts before. The US is not really under US GAAP. They're really just doing GAAP up to IRS standards for what they need for their tax reporting. And then they just had their local UK FRS, and they don't really have a way to just combine those two numbers together without just smushing them together and calling it a day. So they're needing to go through a full exercise and evaluate whether or not they want to go to IFRS or US GAAP, how to consolidate those two together. I mentioned already, those are a couple of different UK fintech companies I've worked with this year. Again, I'm being able to convert them to US GAAP from day one with their operations on the ground there. And then I'm also seeing this a lot with companies that are starting to scale up globally. So Snowplow, for example, is a UK SaaS company in the data analytics space. They had done a Series B fundraise a couple of years ago with some cornerstone US investors and had to go through a US GAAP conversion. So I helped them through that process. They had actually asked their auditors for a referral to another accounting advisor to go through that GAAP conversion. It was a much bigger firm. They were going to charge them an arm and a leg. So I came in and saved them 50% of that cost, and also worked shoulder to shoulder with their team so they had better knowledge transfer. Also worked with some bigger US companies making acquisitions into Europe and just dealing more with the US teams if they're trying to consolidate those finance activities centrally for exactly what it means to keep your local accounting intact and how to make sure that you're building your supporting schedules so that you can maintain those conversion calculations. And then also working with a Netherlands company, for example, that is doing a de-SPAC transaction into the US. So they're essentially getting acquired by a US shell company that's listed on over-the-counter exchange. And they need some help both on the Netherlands side to go through a GAAP conversion from Dutch GAAP to US GAAP. And then also I'm helping with the people responsible for the US shell company just to project manage and make sure that all of their SEC filings are done correctly with the right financial statements. So I'm curious if any of these challenges resonate with your current situation. Happy for you to type in some comments. I'm kind of monitoring the chat off to the side. But if you have any questions, again, type them in. Otherwise, you can also send me an email at any time. I'll respond back and happy to kind of share some insights or bounce ideas back and forth. All right, in terms of developing a strategy to go through your GAAP conversion, this is really the kind of meat and potatoes for what I do and what I like to educate people on. So I've developed this impact roadmap, which is basically an acronym for the different steps that you take to go through a GAAP conversion. And breaking that up into very discrete phases allows you to kind of go through one phase at a time and then stop and assess, okay, what did we identify as the differences or how we're doing the calculations, and kind of along that way, decide if you want to leverage your internal team more because they kind of understand now the findings that you have, or if you want to kind of keep using external resources. So it makes the project a lot more discrete and kind of allows you to break off bite-sized chunks. And then, of course, there are some challenges in just getting through the conversion itself. If you've got a tight timeline to get through a transaction, in some ways you can try to mitigate that by being as proactive as possible. So the I in impact stands for identify, which is identifying the qualitative differences between your current GAAP and your new GAAP, usually IFRS or US GAAP. And in order to do this, we basically take a download of your entire chart of accounts, both the P&L and balance sheet at the most disaggregated detail that you have in your system. We're typically looking at the balances as well for this year and maybe prior year, just to gauge kind of materiality, and maybe there's an account that's never been booked into and we can kind of ignore it. And then we look at basically putting a matrix together and documenting the nature of the transactions that you have in each of those accounts and how those accounts roll up into primary line items on your financial statements. So kind of grouping all the revenue accounts together, for example. Then either the local teams or I'm kind of coming in and doing a walkthrough, and that is reviewing all the existing memos and documenting what your current GAAP is. Obviously, going back and forth with the team if there's questions. A lot of times this documentation doesn't exist so far, so we're kind of putting it together on the fly. But then really where my expertise comes in is lining that up and proposing for each line item, what do your new accounting policies need to be, either for IFRS or US GAAP. And that's really broken down into very granular details that you could basically kind of cut and paste into an accounting policy disclosure as well for, the initial measurement, recognition, subsequent recognition, like fair value discussions, etc. And that allows me then as well to have specific differences identified for your company with action items for how you would take those further to actually quantify them. And then I'm also going through kind of prioritizing what you need to focus on in terms of the line items. So maybe there are some items that are kind of a higher priority, either because they're going to take a lot more effort to go through and identify or quantify rather the differences, or they're going to be a more material difference. So you want to make sure you're assessing them first. The M in impact stands for measure, which is then measuring those quantitative adjustments. So actually, I'm typically kind of doing this together with the identify phase, in that after I fill out those matrix of differences, I'm taking the full company's finance teams through a GAAP conversion summit where we're going through each of those differences one by one, pulling up the supporting files and subledgers in order to develop adjustment workbooks for how you would actually calculate those. So you have not only the initial calculations that you need for the conversion, but then you can also maintain them going forward on a quarterly basis, for example, to book into the conversion ledger. It's also important to consider how those adjustments are going to get consolidated in terms of if you're booking things in one currency, but you're reporting in under another, you want to make sure that you're kind of considering the top side impact as well of those adjustments, potentially on intercompany, for example. And you also want to take a look at the tax impact. So once you have your final conversion TB together with your local GAAP plus your conversion adjustments, you want to run that consolidated trial balance through whatever tax files you're keeping, because you may have deferred tax impacts for that adjustment as well. The P in impact stands for prepare, which is preparing those conversion entries, which I know we've kind of already discussed that. We did the calculations. It's just a matter of making sure we have the right accounts created and the chart of accounts to accommodate that. A lot of times it means setting up new accounts that are more US GAAP specific, for example. But it's also important to assess the system itself and exactly how you're going to book those conversion adjustments. So some more sophisticated multi-GAAP ERPs will have different ways of actually having kind of like a drop down of which GAAP you're in, so that you can kind of combine or prepare standalone statements across any of the GAPs that you're operating in. Others are maybe not that sophisticated, where instead the way that companies are dealing with this is to almost create like a separate legal entity where just those conversion adjustments are housed. so that you can add the legal entity with the stat GAAP plus the legal entity with the conversion adjustments together and get your US GAAP IFRS TB at the end of the day. It's also a matter of just testing to make sure that all works appropriately so that you're able to create those standalone accounts when you need them under US GAAP across your legal entities, as well as then obviously the consolidated US GAAP accounts. Some of those adjustments will be kind of one-time adjustments that you just need to make to kind of get up to a US GAAP standard. And some of them will be more recurring in nature. So it's helpful to tag those in terms of how you might have to reverse them in the system or track them and book them on a quarterly basis as well. The A in impact stands for assembling the financial statements. So obviously, if you're going through a GAAP conversion to do fundraise or get acquired, et cetera, you're probably needing as well full financial statements in US GAAP or IFRS. So it's not just a matter of getting the trial balance together, but there's also a lot of differences in how the financial statements themselves look. So you'll not only need the primary statements, but you'll need a lot more disclosures than you're normally used to seeing under whatever statutory standard you're in. So I'm typically coming in kind of helping companies draft those disclosures for the first time. And the way that we do this is try to benchmark you against some peers. So I have a very expensive software called IntelliGize that I use. It costs me like 5 figures a year, but it allows me to do very detailed searches on SEC filings. So as part of my normal process for taking companies through a GAAP conversion, I'm typically also putting together a list of peer companies so that I can not only benchmark against them in terms of actually looking at their accounting policies when I'm writing up what my clients' policies should be to make sure that they're aligned if that's something that's important to them. But then also we can kind of leverage those disclosures to have a template for our own financial statements so we don't have to create everything from scratch. And then, of course, if you're going through an audit under this consolidated GAAP, you're going to have to prepare a disclosure checklist as well. There's very specific ones for both US GAAP and IFRS to basically give your auditors comfort that for each standard that's material to you that you assessed anything that could possibly be a disclosure. The C in impact is creating the audit documentation and the audit trail. So again, I will say it's important to have a very proactive conversation with your auditors. They're typically going to first audit you up to local GAAP and then audit your conversion adjustments separately. So it's important that you've documented the actual process that you're going through as part of this GAAP conversion. So I'm typically preparing an overall conversion approach memo where we outline how we went through the conversion itself to identify completeness of all the possible adjustments. And then specifically for all of the rest of the accounts that don't get their own memos, we also kind of drop in how like the process that was followed to quantify those differences in the financial statements. And then more significant accounts, like normally revenue, leases, intangibles, maybe if you've had some acquisitions, if you've done a restructuring, if you've done a Delaware flip into the US, those would typically warrant their own memos to kind of lay out the standard in more detail for how you've arrived at the conclusion for what your policy is. So that's typically part of the audit documentation as well. And then just wherever you're developing those supporting work papers that show the conversion adjustments, just make sure that they're clear and presentable and can be passed on to the auditors. And then the T is just transferring knowledge for business as usual. So I know that I'm only working with companies for a specific point in time. And I want to make sure that their team is empowered to actually understand the day-to-day going forward. So like I said, I'm typically going through a GAAP summit with them and making sure the full finance team is involved and understanding those differences and how all of the supporting files have been set up. And that matrix as well kind of serves as an SOP then going forward the team can reference for how to, on a quarterly basis, go through and quantify the differences for your conversion ledger. And this is also where it's important to collaborate with whatever external, whatever external advisors you're bringing in to support that GAAP conversion, because you really don't want them to do this process for you in a black box. Otherwise, you don't have an understanding for how it's been set up and how to maintain it. And that's just going to even add to your fees because then you're going to have to rely on them more and more as you're going through an audit for the first time, for example. So this is what I'm really focused on, is just empowering those companies to be able to maintain it themselves. I see this even with European companies. It's very hard in Europe to find good experts, when you're talking about like a senior manager level, that have not only US GAAP experience, but even IFRS experience. And a lot of times, just because you have these types of reporting requirements, especially if you're not public, it maybe doesn't make a lot of sense for you to go out and hire a full-time person in Europe that has that skill set. So this kind of knowledge transfer really allows you to empower your team. I mean, if you have a really strong technical local accountant in Europe, it's going to be pretty easy for them to grasp what this conversion process looks like and what are the differences and how do they go through and account for those. And so you can actually feel pretty comfortable in handing some of that responsibility to the European team. And then I'm typically staying on as almost like a fractional chief accounting officer if there's like more complex topics or new revenues, new standards that come out, where they can keep bouncing ideas off of me, but they don't have to feel like they're tied to an advisor all the time. In terms of the timing considerations, and I will caveat that this is more related to transactions where there's a fundraise or an acquisition and not so much an IPO. With an IPO, you really have to front load all of this before the close, obviously, because you need full US GAAP or IFRS audited accounts in the registration statements themselves. But when it comes to fundraise or acquisitions, a lot of companies are bringing me in too late in the process after they've already closed those transactions. And it's only then where they realize, hey, we have this requirement that we need to now start producing US GAAP accounts. Can you help us? And the timeline then is typically shortened because they only have maybe 3 or 4 months to get those financial statements done, get through an audit before they have their first reporting requirement to their stakeholders. And so if you know that you're going to be going through this type of transaction, there's ways to be proactive and pull forward some of the work without being super cost inefficient. So even before the transaction happens, there's really no harm in documenting better what you're doing currently, because that helps you even with your current SOPs. And it would make working with an advisor a lot easier because then you can hand all that over to them and it's already, spelled out exactly what you're doing. You can also start the process of going through a GAAP conversion, but not finish it. So if you think you might be going through a fundraise, you can start with the I in impact and start identifying the differences from a qualitative perspective on what you're doing now versus what US GAAP would have you do, for example. And the reason why I advocate this, especially when it relates to M&A or fundraising, is that I think it really helps companies when they're going through a diligence process to be able to show to whoever's on the other side of that diligence process that they understand what those differences are. If you can speak to the differences in an intelligent way and even potentially put together kind of a very high level quality of earnings walk to show what your US GAAP would be, I think that speaks volumes in terms of your stakeholders having confidence in your team and making sure that you can run it day to day going forward. And then, of course, depending on the timing of producing those financial statements themselves, you can then continue on the steps that you would take. But this allows you to really piecemeal the approach and do one piece at a time, when you have the resource availability and kind of the budget to do so. So I'm curious if anybody has questions so far on why or when you might need to go through the GAAP conversion. Again, always happy for emails if you'd like to send those over instead, but I'll just pause for a second here. Okay, no questions so far. So in terms of, like I said before, some of the tangential topics that companies are also dealing with when they're going through GAAP conversions, especially for the first time, are around foreign currency, how you're consolidating multiple entities, and how you're dealing with integrating your systems to be able to maintain that. So in terms of foreign currency considerations, there's typically a couple of different common FX issues that I'm seeing in cross-border transactions. The first is paying attention to assessing your functional currency correctly in each of those legal entities. So this is something that actually trips up quite a lot of people. because you could have a different functional currency decision locally versus what you would have under US GAAP, for example. I'm actually working with an Austrian company right now where locally their statutory accounts are pretty obviously in euros. But when we did that functional currency assessment under US GAAP, because most of their investment has come in USD and most of their revenues in USD, their functional currency in Austria is actually USD. So they had to change the way that they were dealing with kind of the translation versus transaction adjustments and how you deal with that. So it's something important to consider in terms of how you're consolidating and what currencies you're using. There's also potentially differences in the remeasurement and where they're showing up in the statements themselves. So that's something to kind of keep an eye out for, and just making sure you're assessing, what are the functional currencies for each entity? How does this line up to the parent company's currency? There may also be differences in the GAAP standard in terms of how you consolidate those currencies if you have multiple layers in your structure. If you just consolidate the currencies and translate the currencies up to the parent company, or if you have to do it first to kind of the sub layer and then on to the parent company, that might result in some differences in terms of the FX gain or loss as well. Again, just tips for success is just making sure you have clear documentation for the rates that you're using. You just want to make sure that's clear to the auditors, especially when you're dealing with a lot of different rates and how you're revaluing monetary, non-monetary accounts, and especially related to the accounts that are staying at historical FX balances, like equity, PP&E, for example. This also can become quite challenging in the system in terms of how the system is set to recalculate that. You want to make sure that you have really distinct rules around that. In terms of consolidation practices, and some differences in the GAAPs themselves. So there could be differences in the accounting treatments for non-controlling interest, for example, between US GAAP and IFRS. So there's sometimes differences in, the intercompany consolidation or the intercompany eliminations and how you have to think about those as well. And then just making sure that you're actually aligning all of the local GAAPs of the subsidiaries to the parent GAAP before you do the consolidation. You don't want to just be kind of pushing two trial balances together and calling it a day. And it's really important that each of your subsidiaries has its own standalone US GAAP trial balance, because I've seen instances in the past where, depending on the types of tax prep you need to do, and depending especially on the type of legal entity that's your parent company, for example, and some of the different tax implications with pass-through P&L, et cetera. Again, I'm not a tax expert, but I've just seen these types of requests that your tax experts will ask you for those. They want a US GAAP USD TB, they want a US GAAP Euro TB, they want a local USD TB, and kind of it's important to be able to pick and choose out of your system which ones you're able to prepare for each legal entity itself. And then again, just being able to reconcile what are the differences at each legal entity goes a long way in terms of, even if you're maintaining as a first step the US GAAP TB and backing into the local GAAP TB, which I normally don't recommend that companies do, but you still want to be keeping up that process on at least a quarterly basis. You don't want to be just doing that on an annual basis if you can avoid it, if you have the resources, because it becomes then obviously a lot more work to do that once a year. But it's also important because if you're not able to reconcile consistently what your local GAAP books are showing whenever you're submitting VAT returns, for example, that VAT return liability locally is still getting reflected on your US GAAP books as a tax liability, for example. And so if you have a balance on your US GAAP books that you can't fully reconcile, it's going to cause you issues down the road. And I've dealt with this firsthand in private equity, having to reconcile through years worth of VAT accounts that we didn't really have any support for. And it basically becomes like trying to pull gum out of your hair. So definitely recommend just keep the reconciliation going for your local US GAAP accounts. And then in terms of system implementation or integration, like I mentioned before, companies are typically dealing with maybe bringing in a more sophisticated ERP that can manage some of those multi-GAAP, multi-FX issues that they're dealing with. So there's challenges as well because it's typically the same internal resources that are working through a system implementation as would kind of help either work through themselves or help an advisor kind of deal with a GAAP conversion. And so you want to make sure that you're balancing resources that way, but also looking at the timeline appropriately to make sure that you understand the differences in your conversion ledger first before you start doing a system integration so that you have the right framework set up for that. And in terms of working with advisors and auditors, advisors can, of course, help you through a lot of these topics because when you're going through a GAAP conversion that's related to some sort of complex transaction, it's not normally something that you need an internal expert in-house for, unless maybe you're a huge Fortune 100 company, and I've actually worked with some of them that has a whole M&A team and kind of international accounting consolidation experts. You typically don't need that level of expertise in-house if you're not going through these transactions all that often. So advisors can normally help you with obviously the GAAP conversions, going through IPO readiness and execution and making sure that your SEC financials and filings are clear, especially when you have maybe limited capacity in-house and just need some help kind of pulling those together when you have tight timelines for your stakeholders. And they can also help provide you with the technical expertise for more complex topics. Like I said, putting together specific memos around maybe goodwill, for example, if you have an acquisition, and just helping you think through the logic for setting up those new standards, creating the templates, the workbooks, whatever documentation you need so that ultimately your team can run with it going forward. And they can also help you work with auditors, by the way. This is something I see quite often in Europe when I'm helping European finance team through a US audit. European finance teams are typically used to dealing with statutory audits, which are significantly different than an IFRS or US GAAP audit. They don't normally have to go through walkthroughs the same way to understand their controls and their processes. The way that they're testing is normally very different. And it's more of like, I don't want to stereotype, but it's a little more like a check the box exercise where you have to really specifically follow exactly what the statutory requirements are. And there's not a lot of wiggle room. And the financial statements are basically just your tax report at the end of the day. So there's not a lot of, hey, we don't need this disclosure type of thing. So where I'm really helping European finance teams to go through a US audit is to understand the process that the auditors are going to follow and specifically what they're looking to see in your memos. And also then, especially when they're reviewing the financial statements, helping you push back where maybe the auditors, on the other hand, are also kind of going through their own check the box exercise to say, hey, we think you need this disclosure, but you actually don't need it. And it's not something that you even should maybe present in terms of something that might be proprietary, for example. So it's just helpful to kind of have that point of leverage to push back when needed. And in terms of preparing for audit, like I said, just have these conversations early and often with your auditors. I have a hard time even telling a company that they should use my support if they haven't talked to their auditors first about going through a GAAP conversion, because it's hard to agree on the scope for what documentation they need and what memos they need. And so even though I don't recommend that your auditors do the GAAP conversion for you for several reasons, it's important to still engage with them early and make sure there's a common understanding for exactly what documentation you're putting together. Just, you don't want to get through the audit process and have some surprises at the end when they think that they're doing a US GAAP audit and really you've just pushed the numbers together and haven't fully evaluated what the conversion adjustments should be to actually completely consolidate your US GAAP policies across your different jurisdictions. You should also, I recommend sharing these types of conversion memos and significant memos piecemeal with them when you can. And if, it's typically going to be maybe a little bit more in your budget to get through an audit if you want them involved throughout the year. A lot of companies, when they're scaling up, will have interim work done as well. But it's helpful to have that type of agreement on the higher risk areas so that there's no, again, surprises kind of late in the game there, and that you're all on the same page potentially, especially when there's policy allowances or a lot of management judgment that you're making. An area that I see this a lot, for example, is stock-based comp. So it's helpful to just be able to push ideas back and forth with the auditors as well. And they'll want, of course, normally an overall conversion memos on the differences and how you've assessed them, how you've actually calculated them, and all of the support schedules as well for normally the current year and prior year in terms of how you've calculated those conversion adjustments. All right, we are at the final Q&A now. Let me know if you have any questions, or again, if you're more comfortable, you can also send me an email right after this course. I do see that someone has left a comment here. So, are there any tips you share for proactively building internal consensus for following a detailed roadmap before kicking off a conversion? Startup scale-up leaders may not initially see the benefit or value in taking the time to lay a strong foundation versus moving fast, saving money, and just doing it ourselves quickly. Yeah, I think that there can be a little bit of a disconnect for two reasons, especially when you're kind of getting internal buy-off from people who aren't finance and accounting, and you have to, get sign-off from the CEO. And the first is that they might not necessarily understand that you need this type of conversion and kind of overall consolidation to get through whatever fundraise or acquisition work that you're doing. And so it's just helpful to be able to also have other advisors in your corner, whether that's somebody like me who's just putting a proposal together for you and explaining kind of the benefits of pulling that work forward. Or a lot of times it could also be like lawyers or investment bankers, et cetera, that are kind of in the transaction even a little earlier than I am and can help communicate that these are kind of the expectations kind of post-close for what you'll need. And that leads into kind of the second point, which is this GAAP conversion can be a lot more work than a CEO, for example, is expecting if they don't understand how nuanced it is to prepare accounting policies and calculate all of the conversions. And so again, it just comes down to walking them through this process and educating them that, look, this isn't a couple of days work of work. It's normally a couple of months. And so you want to make sure that you're starting with it early, again, because it tends to have a ripple effect down the line in terms of getting through your audit on time, making sure that your systems are kind of up to speed for multi-GAAP, for example. So I don't know how much that helps you, but I hope it lends a little bit of color there. Are there any other questions coming through? It doesn't look like it. So I guess we will end it here. Again, just send me an email to katrina@kn-cpa.net if you have any other questions, or just write me a message on LinkedIn. I think I'm the only Katrina Nacci on there. Oh, somebody did ask me a question. How do you handle expenses paid in the US on behalf of the acquired entity in Europe, like lawyers' fees? Do you push it down or do you need an actual rebilling? I guess this could depend on specifically how the transaction is structured and what the lawyers are doing and whether they're more advising the acquired company in Europe or they're advising the acquirer in the US. You obviously want to just be booking the expenses kind of where they're most appropriately in terms of who's getting the help from which legal entity. In terms of pushing things down and rebilling, this is maybe something that I could have put it in a tangential topic, but transfer pricing often comes into play as well when you're dealing with multi-GAAP entities and multiple jurisdictions. I'm not a tax expert, so I would have to kind of refer you to somebody for that, but I would definitely recommend don't just start pushing things down or rebilling. Make sure that you have appropriate transfer pricing documentation and an assessment done if needed so that you have the right markup on that. It's kind of outside the scope of GAAP conversion specifically, because normally when I'm going through a GAAP conversion with a company, it's really a conversion for the consolidated group itself. So even though I recommend that you're able to produce individual GAAP TBs across the different local jurisdictions, when you're dealing with putting together US GAAP financials on a consolidated basis and getting through an audit, some of those, intercompany transactions end up falling out of the picture. So maybe not as important for going through a GAAP conversion, but definitely important from a tax perspective. All right, seems like that's all of the questions now. So again, just give me a shout if you have any questions. Happy to answer them. Oh, no, got another one. Could you elaborate more on the configuration of systems for ensuring alignment between US GAAP and local GAAP? It's more just specifically understanding how your current system might be built to deal with multiple, essentially like sub-ledgers being rolled up into one consolidated ledger. So there's some systems that I've seen that you can't really, within the system itself, have, for this legal entity in the UK, keep a separate ledger for the statutory UK GAAP, the conversion adjustment GAAP, and also, potentially like intercompany eliminations, et cetera, and be able to then in the system combine those into one UK US GAAP statement. Sometimes you can't do that in the system, but there could be ways around that if you are wanting to stay in your same system, which could be to add another system kind of on top of that. I've talked to a couple just this year that are developing new ways of working in that space where they can kind of plug APIs into a Xero or a NetSuite or Sage, et cetera. And even though you might be in different systems across your different local jurisdictions, as long as you can map all of your chart of accounts in a common way to US GAAP or IFRS, they can actually plug into multiple systems to roll it up that way. So that's something that is maybe more of a stopgap solution for a couple of years. I wouldn't necessarily recommend that to a company that's looking to go public because going through a public company audit, you typically also have to then go through an audit over your IT systems in a little bit more of a rigorous way. And I can see, I'm not an IT auditor, but I can see that posing a lot more challenges when you're dealing with those complex APIs. So that's why companies start to switch then, I think, to like NetSuite or SAP is the most, I guess, high-level example to be able to do that in a bit of a more streamlined way within the system itself. And also those more rudimentary, I guess I'm calling that, accounting systems tend to also have very similar challenges, like I mentioned, with the multi-currency and specifically like building in really robust rules for how they're revaluing that and rolling that up across different kind of functional currency consolidation conclusions that you have. All right. I'm afraid to say that we're ending here because we may have another question come in. But I think if you're asking questions from LinkedIn, you can also probably still continue to leave those as comments in the event. So I could go back and check that as well if it's easier. But thank you all for joining and for asking questions. I really appreciate it. Again, this can be quite a complex and daunting topic. So I'm always happy to talk if you just want to send me an email or reach out.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.